client came in the other day, accountant had advised them to do the Div 7A loans, even though in the next 5 years they're going to go retirement. And the whole idea was that in retirement they would build up this big balance in their company, and then they pay that off with dividends, and you're only taxed at 25%. You could maybe pay yourself 45, 50 grand a year through those dividends, not pay a lot of tax. Not a bad strategy, but not the best strategies. For really wealthy people who've topped out their super for retirement, say there's two owners and they both have 1.9 million in super, then that's a great strategy. But it's not a real great strategy before they get to that stage. These people only had around about 600,000 in super. So what you would be doing is you would be, as you get your company profits, you'd be taking a higher wage, so you don't end up with this Division 7A loan, and then you put the money into super because you've got such a big balance. They both had around 90,000 in carry forward super. That 600,000 was actually combined, and they both had around 90,000 where they hadn't actually made contributions into their super. The concessional contributions taxed at 15%. So if you can pay tax at 15%, you'd do that every day of the week rather than pay 25% tax. And then when it goes into when you retire, you pay 0 tax. So that is a much better strategy to maximize your super before you start focusing on this strategy here. And that strategy works if you've got excess profits and you need to distribute those, or you don't want to pay money into super, then you can do the dividend strategy. But that's a few different strategies for business owners that are doing well. Thanks very much. Number here is 0756101945 and email nerang@abtac.com.au. Thanks for listening.